With a better understanding of trends from theory and looking at real charts, it's now time to look at trading patterns. Trading patterns are visual formations that signal trend reversals and trend continuations. When a price pattern signals a change in direction of a trend, it is known as a reversal pattern. A continuation pattern occurs when a pattern signals that the trend will continue after a pause, that the market could digest a move that occurred and accumulate for the next move. Patterns are identified by connecting trend lines between price highs, lows, and closes within a specific time period. By themselves, patterns do not predict moves. Rather, they signal the strengthening and weakening of a trend, as well as breakouts and breakdowns that have more often than not led to a certain price action in the history of charting crypto and stock markets. We do not rely solely on patterns. We identify them and use them as another tool in our strategy so that our trades can be supported by more evidence. Along with patterns, we use a stop loss that will exit our trade if the pattern becomes invalidated so that we don't lose too much money. There are many chart patterns to look at, but in my years of trading there are only a handful that appear often and have been very useful. We'll go over the most important ones. For continuation patterns, the most common ones are pennants, flags, or triangles. After a big move, price consolidates within a tight range so that traders can digest the move that just occurred. More often than not, the prior trend continues after the consolidation. If the price was heading upwards, it would continue to move upwards. If the price were in a downtrend, it would continue trending down after the pattern. We call them bullish pennants, for example, in uptrends, and bearish triangles, for example, in downtrends. We can measure the size of the next move easily. The target will be the same size as the move that preceded it. If price moved $50 and then consolidated, for example, the following price target will be $50 above the consolidation. As price is consolidating in these patterns, volume should be tapering off lower and lower. If the price breaks out from either end of the pattern, this breakout or breakdown often signals where the new trend is likely heading. As we went over in a previous lesson, we place our stop loss 1 to 3% outside the range of the pattern to exit our trade if the price heads in the wrong way so that we can secure our capital. If there is no breakout 3/4 of the way through a triangle, or if a pennant becomes greater in length than the move that preceded it, this means that a sideways trend has established, and we use our strategy for trading ranges that we will cover in a later lesson. Now, to better illustrate the concept of continuation patterns and how to measure them, we could take a look at the Matic chart on TradingView. So in mid-July of 2021, Matic began to print this pretty big uptrend. So for example, if we went over here and drew a trend line from the bottom of the pole all the way to the top of the pole of this bullish pennant, we could take that move that we just measured and drag it onto the breakout of the pennant, which would be right here. So if you notice, it actually hit the target pretty spot on. And also notice that every retracement in this uptrend was not a complete downtrend because we didn't break down below this bottom trend line that we could draw right here. These ended up being simple retracements that you could have added on to your position to make even more money. The next type of pattern is the reversal pattern. These types of patterns show weakening of a trend and can often indicate that a trend is changing its course. This can be very profitable because you can get into a trade at the beginning of a new trend. There are many reversal patterns. For now, we'll go over the most common but powerful ones. Firstly, let's look at the head and shoulders patterns. Keep in mind, reverse or inverse patterns are the same patterns but in the opposite direction. The regular head and shoulders that you can see on screen is a reversal pattern indicating a trend change from an uptrend to a downtrend. Notice where we see just after the head, the next wave of price action makes a lower high, which tells us that momentum to the upside is weakening. It's the same concept that we've seen before, manifesting itself as a visual pattern that traders can see. To trade this pattern, we look closely at what we call the neckline, right here, which is the trend line that would support the move if it were to undergo a mild consolidation. Breaking this neckline means that a complete reversal is likely underway, and a trade can be placed in the direction of the new trend. The inverse head and shoulders pattern is the same thing, this time going from a downtrending market into an uptrending one. To trade this pattern, enter at the break of the neckline which connects the two tops, and place your stop loss 1 to 3% in the opposite direction of where you anticipate the trend to go. So if you're trading a regular head and shoulders pattern, you would short the break of the neckline, then place a stop loss 1 to 3% above the entry. Also, make sure to watch for the third candle to close outside of the break to continue with the trade, so that you don't get tricked by a fake out. To get a better idea of the head and shoulders pattern, we can take a look once again at the Matic chart. So over here we have the formation of the left shoulder, over here we have the formation of the head, and over here we have the right shoulder. To trade this pattern, we have to identify the neckline. So the neckline would be roughly right here. So as you can see, there are a couple of wicks down past the neckline. But if you would wait using our strategy of waiting 3 candles, you would see that it comes right back up, and that is not the perfect entry. Again, same deal here, but once we get over here, we see that after 3 candles, we close below the neckline. This is your entry point to put in a sell or a short trade. And as always, for risk management purposes, we would put a stop loss 1 to 3% away from the direction that we anticipate the trend to go in. So that would be right about here. In this image, we can see an inverse head and shoulders, which is the exact same concept, except the pattern is flipped upside down and signals a reversal to the upside. The target of these moves is the same distance from the head to the neckline. Just add that to the break of the neckline, as you can see in this image. The next reversal pattern that you'll see often is the wedge. Here in this example, we have Bitcoin in the first half of 2021. Notice here how the support is linear, but the new highs are rounding off like this. This signals that each new high is formed with less momentum than the last. Noticing this, you can prepare well in advance by watching for a break of support drawn here. The target for any wedge pattern is simply the base added to the break of support. The rising wedge was a very bearish pattern. Now let's look at its inverse, the falling wedge. It's the same concept, but vice versa. Sellers this time are losing strength, and a reversal to the upside is likely. In this example, this marked the start of the last move up in 2021. Which you could have made over 500% profit depending on which coin you traded. These wedge patterns I see in crypto all the time, and they can be very, very profitable. Next, we have the cup and handle pattern. This pattern also plays out very well in crypto. Here I have opened the Hathorn network chart. Right here we see that we're in a downtrend, but we're rounding out, which is the first sign of a reversal as the buyers are stepping in. The price hits resistance and completes the cup. There's a small retracement or pullback, as we call them, that comes back to break out from the pattern and complete the cup and handle pattern. The target of this pattern is the size of the cup added to the break. Just Look at how accurate this trade is with such little risk. By knowing this pattern, you could have accurately calculated your massive profits before they even happened. This is amazing stuff. Now, if we take a look at the charts, almost any chart you open will have this classical double top. We make a high, the whales sell off, then they push the price up one more time so that people think it's going higher, then they sell off again at the same price. Anyone with a long position at this point will be stuck. The area of interest is the low between the tops, right here. If price breaks through here, it's usually lights out for the bulls, and you can measure the move downward by taking the difference between the high and the low of the M. It's usually obvious that a double top is in play if the price changes are very massive. To properly trade a double top, you go short when price breaks through the middle low right here, and set a stop loss at the usual 1 to 3% in the opposite direction. A W bottom is the exact same thing, but the other way around. Let's take a look now at AVAX on the 1 hour chart. We can see multiple W bottom formations, like right here, and another one right here. As you can see, price comes down and hits the same area twice before breaking out of the resistance, which is right here. The target of a W bottom is the size of the formation right here, added to the breakout, like this. We can see in this case, if you got in at the breakout, you would have made roughly 49% on this trade. So now you've made it this far, congratulations. You're ahead of most traders now. We covered trends, ranges, support, resistance, key levels, continuation, and reversal patterns. I encourage you to open up a chart and observe the different patterns that have emerged. Look at the breakouts. Look at the fakeouts. There are many, and that's why we wait for confirmation and protect our capital with a stop loss. Look at how support and resistance switch. Look at how volume makes a difference. These are the basics. We'll go over how to combine everything once we've covered more topics. With this information alone, we're able to execute profitable and safe trades. However, this next topic will advance our trading by having convenient calculations plotted onto the graph to assist in our analysis. Let's take a look at indicators next. There are thousands of indicators. Programmers are able to create indicators by coding with PineScript. So I will go over the most popular ones used by retail and institutional traders alike. It is by using structural, pattern, and indicator analysis that our trading plan will give us the upper hand when executing our trades. See you in the next lesson.